Would you believe that one single rumor was enough to make thousands of investors rethink Netflix's entire future? For years, Netflix has dominated the streaming world. But recently, a powerful idea started circulating across financial media and Wall Street discussions. A possible Netflix and Warner Bros. Deal. A move so massive that it could completely reshape the entertainment industry. But here's the truth. There is no confirmed acquisition, no official deal, no signed agreement. What is real is the impact that this rumor has already caused. And what's coming next for Netflix might be bigger than any merger. Let's break it down. Netflix today is not just a streaming app. It is a global technology and content empire. With over 260 million subscribers worldwide, Netflix has transformed from a DVD rental company into one of the most powerful entertainment companies in history. But growth is slowing. Almost everyone who wants Netflix already has Netflix. That's why the company is now changing its entire strategy. Higher subscription prices, advertising plans, games, live content, global productions. Everything is evolving at the same time. And that's where the rumor of Warner Bros. Enters the picture. Warner Bros. Discovery owns some of the strongest brands in entertainment. DC, HBO, Harry Potter, Game of Thrones, Discovery Channel, and much more. The idea of Netflix absorbing that content instantly created shockwaves across the market. On paper, it sounds unstoppable. Netflix would gain one of the largest content libraries in the world. HBO-level production quality, legendary intellectual property, and massive control over global entertainment. But reality is far more complex. A deal of this magnitude would face brutal regulatory resistance, anti-monopoly laws, government interventions, international approvals, and billions of dollars in added debt. Warner Bros. Discovery itself carries heavy financial burdens. Combining that with Netflix's already massive content spending could create dangerous pressure on cash flow. That is why today, the deal remains only a rumor. A powerful rumor, but still a rumor. Yet even without any official announcement, the market reacted. Netflix's stock price showed increased volatility. Traders, analysts, and long-term investors began debating one question. Is Netflix preparing for its biggest transformation ever? And the answer is yes. But not necessarily through Warner. Netflix's real strategy right now is focused on three key areas. First, advertising. For the first time in its history, Netflix embraced ads. This completely changed its revenue model. Instead of relying only on subscriptions, Netflix can now extract value from both users and advertisers at the same time. This move alone turns Netflix from a pure media company into a full-scale digital advertising platform. Second, price restructuring. Netflix is no longer competing on being cheap. It is positioning itself as a premium service. Subscription prices continue to rise across regions. Password sharing has been suppressed, and users now pay more, but stay because the content remains dominant. Third, expansion beyond series and movies. Netflix is entering gaming, live content, interactive entertainment, and even experimental formats that blur the line between streaming and social platforms. All of this matters for investors, because Netflix today is no longer valued only as a content company. It is being priced as a technology platform with global reach, data dominance, advertising power, and intellectual property control. So what would happen if a Warner-style deal actually appeared? Short term, the stock would likely surge on hype. Wall Street loves scale. Analysts would upgrade price targets. Retail investors would rush in. But medium and long term, risk would rise sharply. Debt levels would explode. Content costs would skyrocket. Legal battles with regulators would stretch for years, and investor confidence could slowly weaken. This is why many professional investors believe Netflix will continue growing through internal expansion, not mega acquisitions. And this brings us to the real future question. Can Netflix keep dominating without buying its biggest competitors? Right now, the answer is yes. Netflix still leads in global distribution. It understands regional markets better than any other platform. It creates local content that becomes global hits. And it controls one of the most powerful recommendation engines in entertainment. Disney struggles with profit. Amazon treats Prime Video as a side product. Apple loses billions on content. And Warner continues restructuring. Netflix, despite all challenges, remains financially focused, ruthless with numbers, aggressive with strategy. This is why the stock continues to attract both growth investors and long-term holders. But the next few years will be critical. If advertising explodes, Netflix becomes unstoppable. If price resistance grows, growth could slow. If competition innovates faster, dominance could weaken. And if one day a real mega deal ever happens, the entire market will shift overnight. So, what's the real conclusion? Netflix does not need Warner to survive. But a Warner-level move would change the entire industry forever. For now, the real story is not what Netflix might buy. It's what Netflix is becoming. A global digital entertainment machine with three core engines: content, data, advertising. And Wall Street is watching every move. The next phase of Netflix's story is no longer about movies. It's about power.